In the stock market, one topic that's heavily debated is time in the market versus timing the market. In this video, I'm gonna share everything that you need to know about this topic, as well as some study to be able to shed light on some of the myths and some of the realities of both of these possible investment strategies. And if you stay until the end of the video, I'm gonna show you how you can apply these investment strategies effectively, so that way you can reap the rewards of your portfolio growing and growing over time. Okay, so let's talk about what timing the market means. Timing the market basically means trying to predict when a particular stock or a particular index will hit the highs so that you can go ahead and sell at that particular time, and when the lows will hit so that you can buy low and sell high. So you're trying to maximize the return that you can make versus time in the market. It's a very different philosophy. Instead of trying to predict when stuff is going to go up or when stuff is going to go down, what you're going to do is you're going to invest and contribute to a particular investment account on a regular basis, regardless of whether the market is going up or whether it's going down. There's been many different studies, and I'm going to show you one that was conducted recently by RBC that look at the two different strategies and show you what are the things that you need to know in terms of applying one investment strategy versus the other. So to give you a practical example of these two different strategies, I've created a spreadsheet just to illustrate the point. So in this case, this is the time in the market strategy, and this would be trying to time the market. So in this case, what we're looking at is the S&P 500 index, and this is what the value of the index in this hypothetical case has gone either up or down. This is the amount invested. This is the number of shares bought, and this is calculated based on the price of the index and the investment that you're making every single month. Here, this keeps track of the different number of shares that you've bought, and then here, this keeps track of the value of your portfolio. At the end of the day, you take the sum of this basically, and this allows you to see how much you've gained or lost in your investments, how much you've invested, how many shares you've invested at, and also what the total investment that you've made has been. We've also had the average cost that you've paid for the index, so this is also helpful. But now let's walk through the example, and you can also see how the same concept applies exactly in the same way. We're gonna go to this scenario a little bit later. So starting off, we can see how the index goes up and down at different periods. The contribution remains equal, the number of shares based on the price goes up and down, and so on and so forth. The thing that matters and what this proves is that if you follow this strategy, what's going to happen is that you can actually make a higher profit than if you follow this strategy right here. Now, of course, this depends heavily on the situation that you're analyzing. That's why I want to show you a professional study done on this. But the reason why this happens is that because you're able to invest consistently, you're able to essentially lower your cost per share over a long period of time for that particular index, because you're basically capitalizing on when the stock market's going down and you're buying, and if it goes up you're buying. But that's fine, because over time the market has consistently proven that it grows over a certain percentage, usually about 7.5% per year roughly. And so with this strategy, what you do is you forget the hassle of having to track prices and know when to buy, when to sell, what's happening in the economy. You just stay consistent, and over time you can reap the rewards. So that's a really good strategy. The other strategy is the timing the market. So in this case, this person, instead of investing consistently, they decided to invest all of their money on month number 7, which is not a bad month at all. In this case, they were able to buy at 105, which is actually a pretty good price compared to some of the highs that the index had, in this case 125. So they bought at 105, and then they've never invested again. The index went up and down in value, so did their total portfolio value, and they did make a profit. They were lucky enough to be able to time the market in a way, but as you can see, the profit is lower, and the reason why is because they weren't consistent with their investing. So generally, for most people, it is better to be able to stay in the market, so spend time in the market, riding the cycles, and continuously investing into different investment accounts that you may have. And now what I want to do is I want to share with you the professional study that found this. Okay, so here's a study, time in the market versus time in the market, and this study was conducted by RBC, the Royal Bank of Canada. And as you can see, these are the two different scenarios. So in this case, we have three different investors, and here you can read exactly what the situation is. But basically, they're all investing $5,000, and this is happening on January 1st, 2000 of the year 2000, and they have the two different scenarios. Investor one, this is the one at the top, was lucky and invested when the price had dipped to the short-term lows. So he was really good predicting when the market was going to be down, and he bought at the right price. Investor two did not attempt to time the market, but rather invested a regular time interval. So this is the time in the market approach. He was smart. He was like, you know what, forget it. I'm not trying to predict when the stock is going to go up or down, but instead I'm just going to stay consistent, invest in my investment account consistently, and then we'll see what happens. And then investor three tried to time the market in a way, but he was unlucky and he bought at the short-term highs. So you can see they've all invested $5,000. In this case, this person made 10 different investments of $10,000 at short-term market lows. So he was very, very lucky. This person instead said, you know what, I'm just going to invest $365 every single month. And this person did the same as this person, except they didn't invest too well. At the end of the day, they've ended up investing $105,000, and this is by the year 2022, September 30th. And you can see the different investment balance of their accounts. So at the top, the luckiest person made $199,000, which is pretty good, pretty decent return over time. Investor number two made $183,000, and investor number three $177,000. So as you can see, what's crazy about this study is that it shows that even if you're absolutely the most lucky person and you time the market somehow, you're still not gonna make that much money in comparison to somebody that just stays consistent. Now, at the same time, if you invested and you weren't the most lucky investor out there, but you've stuck in the market over time, you're also gonna be making a return. That's what the study proves. So in this case, the return is actually not bad at all, and this is the unlucky situation. So this is not bad at all. However, for most people, what is recommended is that you take this option, so that way you don't have to worry about when it's the time to buy, when is the time to sell. You just stay consistent, and then at one period of time, then you cash in, get that money, and then you can put it to work into any other investments that you want, into retirement, and all that type of stuff. And for this, what's critical is that you have an investment account set up that's tax efficient. So you can look at 401ks, Roth IRAs, and stuff like that that allow you to, at the end of the day, be able to cash in this amount and do it in a way where you pay less taxes. Okay, so now that you know that time in the market is the best approach that you can take to be able to generate sustainable returns over time and do it in a way where you're not killing yourself with another job, essentially, how do you practically apply this approach? So the way that you can do that is very simple. What you need is to, when you invest in a particular stock, securities, ETFs, all that kind of stuff, you need a good broker. And for that, we recommend a broker like Vanguard. We're not associated with them. We're not getting commission for this. This is just a genuine recommendation, but you can also use some other ones like Schwab, Wealthsimple, Robinhood, all those ones. However, what you also want to look is the ability to make automatic investments. And this is what we like about Vanguard. So here they walk you through how it is that you can set it up. So that way every month, once you get your paycheck, you can set up automatic investments, and that you're consistently investing and you're having that smart approach of not trying to time the market, but spend good time in the market and reap the rewards over the long term. Once you have that set up, it becomes very simple. After that, you just need to worry about taxes every year, and you don't even have to think about your investments for a long time, unless you want to be a little bit more active and invest into some particular stocks and whatnot that may require some analysis. That's also a good thing for your portfolio. But the last thing that comes up is, okay, I know that time in the market is the best approach, but what should I invest in? What stocks, what ETFs, all that type of stuff. So for most people, it is best to invest in ETFs, because ETFs, instead of being individual stocks, they're a collection of different stocks. So that way you have diversification. You can buy them and sell them at any time. And it's generally better when you want to take a more laissez-faire approach to your investing, because that way you don't have to consistently worry about how a particular company is doing, but you're investing more in terms of like different parts of the market, in different sectors and different industries. So it becomes a lot more easier to manage. But how do you pick the best ETFs to invest in? That is the real question. For that, we recommend that you build a spreadsheet like this. So this is using Whitesheet's formulas, which Whitesheets, you can see it right here. It's an add-on for Google Sheets and Excel that provide you with all the stock data and ETF data that you need. So in this case, it's using the Wise Price function. You can see how this works here. It gets the data, you can refresh it anytime. And this allows you to compare different securities one after another so that you can pick the best ones a lot faster. So in this case, we're looking at price, we're looking at volume, we're looking at the dividend yield, we're looking at the dividend payment in 2022, expense ratios, net asset values. You can imagine there's a whole bunch of different metrics that you can get, and that way you can pick the best ETFs, the best stocks a lot faster, because now you can do this for as many companies or ETFs as you like, and then be sure to invest in the ones that meet your specific criteria. Now you're an expert on timing the market versus time in the market, so be sure to use this knowledge so that you can make the best investment decisions for yourself, for your family, and for those people that are most important to you. If you've enjoyed this video, make sure to subscribe and turn on the notifications bell on, so that way you get notified every time we release a new video like this. That's gonna allow you to take your investing game to the next level. I'll see you in the next one.